What the Fed is doing, they're trying to attack the wrong thing. They're trying to make you and I, retail spending, go down. Problem is, it's the governments that are spending the money. The more they raise rates, the worse it gets for the government and the more money they spend. You and I, when we go broke, we stop spending money. The government doesn't. The government doesn't. The government just runs bigger deficits. That's what they do. When inflation is caused by runaway fiscal deficits, government deficits, high interest rates won't stop it. They won't do much to do it. It forces the governments to borrow even more money. But the problem is like I said, is that as the Fed is raising rates and then the government's borrowing more money, the cost of that borrowing goes up. But it also does something else that's really bad. As they're trying to bring you and I, our spending down, consumer spending down, they're making us broke. So our houses aren't worth as much. Our stocks aren't worth as much. We're not buying and selling as much stuff. We're not making as much money. And what that does is then we don't pay as much taxes. So it's a double whammy for the government. One, they don't get near as much revenue. And two, the interest on the debt went up. So that makes a bigger deficit. So now the deficit is going up 2 times. It's like a really, really, really bad situation for the government, which is why all of this just makes the problem even worse. Over time, raising interest rates and keeping them high in an environment like we're in now with runaway government deficits and high government debts are causing inflations, and they just make it worse. To understand this a little bit, we want to take a look at some other examples, like for example, in Turkey. So in Turkey, we can see that they've been running massive inflation over there. As a matter of fact, we've been seeing 80% inflation for the last couple years. What Turkey did, as inflation started going up, they cut rates. But as they cut rates, inflation went even higher. Eventually, it started coming back down. They cut interest rates to under 15% and inflation exploded to over 80%, but for a period of time. Money supply and the consumer price index ended up taking off like a rocket ship for Turkey. But the problem with Turkey's situation is that cutting interest rates did reduce the portion of inflation caused by fiscal deficits, but it made the speculative attacks on the currency and inflation caused by bank lending. So this is the problem. If the Fed raises rates, then what happens is then people don't want to hold the currency, or more specifically, they'll borrow against it and cause that speculative attack. Nobody wants to hold the lira. What they want to do is they want to borrow in lira. When inflation was at 9% and I could get a house loan at 3%, I definitely wanted to do that. If I can get a 30-year fixed loan at 30%, and inflation is above that, 5%, 7%, 9%, I want to borrow as much money as I can, let the inflation pay it off. Problem is that becomes a speculative attack. As many people as they can, they're borrowing more money, but as they borrow more money, that just makes the problem even worse. And then they don't want to hold the currency. It was called a speculative attack. Now, Argentina saw a similar problem. They had an inflation rate of over 100%. I mean, imagine that, 100%. That means your money basically becomes worthless every year. But unlike Turkey, they started aggressively raising interest rates to keep up with it, but yet inflation remains completely uncontained. They haven't been able to do anything about it. It's almost as if interest rate policy isn't the only variable to consider, which of course it's not.